Welcome to our Facebook Live here. I am excited to talk to you about, of all things, taxes. It is now April 18th today as I'm recording this. I'm assuming the last thing you want to be talking about now that tax day is done is taxes. But we're going to be talking about taxes, what you should be looking out for, especially as a real estate investor. My name is Sam Jones. I help real estate investors to do all their financial planning, and I'm excited to jump in today. I'm a certified financial planner, accredited financial counselor. Let me jump in and we can talk through this. I'm going to make myself a little bit smaller. Before we hop into this, I just have to say that this video is for educational purposes only. It is not specific or individualized tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with a tax, legal, or investment advisor. Cool. Now that we got that out of the way, let's jump into the tax forms. Okay, so we're going to be talking about three main forms, especially that I want you to be aware of as you are a real estate investor. The first form is the passive activity loss limitations form. It's form 8682. This is really an important form, especially if you are not what's considered a real estate professional. I'll get a little bit more into that here in a minute. We're also going to be reviewing Schedule E. This is where all the information from our rental properties go. Also, this is known for partnerships as an 8825, Form 8825 on a partnership return. And then the last thing is a depreciation schedule. I threw all these schedules together and kind of created them, so they're not going to be exactly as you might see on your tax return. But these are the actual forms. We're going to go through and we're going to talk about them and help you to understand what to look for as you're reviewing your tax return, as you're thinking through making sure that everything was done correctly. And to really just trying to understand where you stand with a lot of things. Because these real estate forms, believe it or not, are really, really powerful in telling a story. And when someone sends me over their tax return, I can tell a lot about that person and about their financial situation just by looking at these tax forms. And in a way, it's a way to measure your progress and to see how your properties are performing and different things like that. But we're going to jump into this passive activity loss limitation form, Form 8582, and why this form is so important. So if you are what's considered a real estate professional and you materially participate in the management of your property, then this form really doesn't apply to you much, if at all. And that is because you can take your real estate losses and apply them against your W-2 or your business income. What happens though is people have two forms of income, or there's two buckets of income. There's like your active income from business, from your W-2, from all that stuff. And then you have what's called considered passive income. And this is primarily from real estate. And when you have losses from your real estate, they oftentimes can't take that loss and use it against your positive income on your W-2. And that's where this form comes in to tell you if you are using, or if you're getting limited on the losses that you're getting from your real estate. So let's talk about that. So here's this form, generally speaking. If you have net income from any activities, it's going to be on line 1A. For example, say you have a K1 with $10,000 of income that you got, but then you also have some rental properties that produce $25,000 of losses. And this would change to $15,000 and they would offset. So you want to see on here that they are netting. That's something to kind of just look for, is that all your stuff is netting together. Okay. I'm going to take this away, but that's the first thing to kind of look for, is if you have multiple things happening, sometimes they'll be netting together on this form. Not always. Sometimes they'll net together on your Schedule E, but if you have getting K1s and different things, then they'll net together here on this 80. All your losses or income, passive activities, will net together on this form. Coming back, so let's just say you have a $25,000 loss from a rental property or from rental properties. Typically, you cannot take that loss and use it, like I said, against your income, unless there's two exceptions to that. The first is the real estate professional status. I'm materially participating in the management of your property. That's the first, and a lot fewer people than actually think they do, I didn't say that very well, but not very many people actually qualify for that. It's really quite hard to do. I'm probably going to do another video another time about what it takes to qualify as a real estate professional, but just know that if you work a full-time job that's not in the real estate industry, you're not going to qualify, right? And even if you do work a job in the real estate industry, there's still a chance that you may not qualify. So you need to understand the rules. I'll go over that another time. But long story short, there is another exception. And the exception is if your adjusted gross income is below $150,000, then you can qualify to take up to $25,000 of passive losses. Okay. So I just did this though, if you're above that or in that, phases out from $100,000 of modified adjusted gross income to $150,000. So that phase out in this scenario, I just said, okay, the phase out's or the top's 150, but say you make 120. Well, this is where you kind of see what happens. Long story short, you get limited to $15,000 of the 25 in this scenario if you made 120,000. But right here is where you're going to be able to see if you've gotten limited. Oftentimes if you're higher income, this will say zero. You don't get any of that passive loss. This $25,000 that you could have possibly gotten. But if you're below that $150,000 of modified adjusted gross income, this is where you're going to see if you get to use that. I had a client this last year who, in 2022, she qualified and got a big chunk back because her modified adjusted gross income was below that 150,000. Then she got a bonus and had a really good year in 2023, and now she's phased out and she's thinking, oh, why did I not get a huge tax return or tax refund like I always have in the past? Well, this is why, because she can't use her passive losses. They are now becoming unallowed. And I'm going to show you where you're going to be able to see those unallowed losses here in a second, but it's because you're phased out in her scenario. So just know that those are the two exceptions, and this is where you're going to see that exception. On here, you're going to see the properties, current years versus prior year losses, unallowed losses, the net income, net loss, they'll net together. You'll be able to see it all on here. Here's what I want you to see. Normally this will all be filled out, but here is the important part. You're going to be able to see, and I just kind of threw these numbers on here, but you're going to be able to see your losses and your unallowed losses here, and the ratio or percentage of loss that is unallowed. Let's just say, for example, you have a $10,000 loss here, or we'll keep it consistent with below. You have a $10,000 loss on 456 Apple Street. Well, half of that is going to be allowed, and half of that's going to be unallowed. So your ratio would be 0.5%, and 5,000 would be unallowed. So you're not going to be able to take that loss and use it this year. It's going to get carried forward to a future year. So, but let's just say, for example, your income is really high, and all of your passive activity is your modified adjusted gross income is above that 150,000. And so all of your losses are going to be unallowed. This is the key, is you're going to see, let's just say 25,000, or maybe let's just say 15,000. Okay, I'll go with this story above, and we'll say you got $10,000 from a K1 that you got, and this was 15, and this was 15. We'll ignore this section. Coming back down here, so your unallowed losses on both of these lines should show $15,000. Okay, if you have allowed losses, you'll be able to see how much of those losses that you did get. And this is kind of really the cool part, is this section 7 or 8, section 8, you're going to be able to see the total amount of losses that you've gotten, the total amount of unallowed losses, and the total amount of allowed losses that you're able to take to use. So let's just say you're able to take, I'm not saying consistent with my example, but let's just say you're going to take $20,000 of losses and $15,000 of unallowed losses, or whatever it might be. You're going to be able to see that here. And here's the key that I want you to know, is this number on this unallowed losses, that number should get carried forward to future years. And you should be able to use that number, those losses in future years, against your passive income or passive gain. Okay, that's really, really important for you to understand, because I've seen it, and I actually caught one of my clients this year had a situation where he switched accountants, and he had a big, it wasn't that big, it was like $30,000 of passive losses unallowed losses that he was able to take. These got carried forward to 2023 from 2022 and a few years, I think, before that. But he switched accountants, and this stuff typically, when you switch accountants or when your accountant gets a new tax software, typically all of this just carries forward from on their software, so it's not a big deal. But if they switch software, you get a new accountant, then you have to go in and manually input this number. So I caught this for my client where he got a new accountant and went in, and I saw that his unallowed losses from the previous year didn't get carried forward. And so he would have lost $30,000 worth of losses that he could have been using and that he will use moving forward, all because that number wasn't included. So this is an important number for you to know and understand. And really as well, if you're going to sell a property and say you're going to have a gain, you now know that this number is going to go towards offsetting that capital gain, which can be really, really powerful. Let's just do a quick recap of this page. Main things that you're going to know. Oh, and here, let me just show you this before I talk about the recap. Prior year unallowed losses. So right here, let's just say you had $10,000 of prior year unallowed losses. Well, that'll all add together, right? So that gets carried forward each year, and that's where you're going to want to see from your previous year, this number get carried forward to the future years. And I check that every year on all of my clients' returns because it's important that that number gets carried forward and we don't lose out on tens of thousands of dollars, hundreds of thousands of dollars in some cases of losses that could go towards offsetting future income or gains of real estate. So again, if you're going to sell real estate, it's good to know, okay, I have $100,000 or $50,000 of losses that I can now use to offset some of or part of that gain, right? Or maybe all of it. So things should net together, kind of understand and know that, and add together here. You're going to see your total losses combined here. And then coming down further, you're going to see the allowed losses that you're able to take and your unallowed losses that you were not able to take. And again, that number should carry forward. The last part of this that I maybe skipped over is this will just show you if you're above that $150,000 of modified adjusted gross income. And if you get any of that passive loss, because again, there's two ways to get that. This is one of the ways. Most people are probably above that, but sometimes, there's certain scenarios where you can get part of that. That is Form 8582. Again, a super, super powerful and important form to know and to understand and to really track on an ongoing basis, because you don't want to miss out on your passive losses that should be carrying forward because your accountant changed his software or you got a new accountant or for whatever reason. And you just kind of want to understand and know how much losses you have carrying forward. I talk to clients all the time that knew that coming to me and they're like, we're to get talking. And I was like, do you know that you have losses that are built up that you can now use if you sell X, Y, and Z property? Because maybe they're talking to me about selling a property. This happened to me the other day and they had no clue. So this is, again, a powerful number to know and to understand for your situation. Okay, let's talk about your Schedule E. So this is where your rental properties go, and you can see how they're doing, how they're performing. Okay, so a couple things I'm going to talk to you about. First things first, you're going to see your rental property name, 123 Main, 456 Apple Street, 789 North Street. You're going to see the type of investment that it is, single family, multifamily, vacation, short term, all the different types of rentals. Okay, here's an important tip. Fair rental days. This is important because it actually goes quite heavily. I've talked to a lender who does taxes, or does lending obviously, but understands taxes. And when you have rental properties and you want to buy another property or qualify for a loan, they take into account your rental income. And so when they see that, say this schedule, say you bought C, 789 North Street right at the end of the year, and you only got a little bit of income in this scenario and expenses. But if you have, and I see this mistake all the time, where it says 365 the entire year, they're going to see that income and expenses and think, wow, that property is obviously, and they might know that it's only a partial year. They might not, but the lender has to go off of the tax return. So they can only take part of that income and use it based off of if that was over the course of an entire year versus if it was instead over like 60 days or whatever. Then they can use that income as if it was over 60 days, and it becomes a lot more beneficial for you and helping you to qualify for your next loan. So that's kind of a loan tip, not necessarily a tax tip, but something to understand and to look for is the fair rental days. The personal use days, that's typically not applicable unless you're like using your rental property. If you use your rental property for more than 14 days, then you can't essentially take losses on your rental property. You can only offset income. And there's some other rules around that, but that's the main thing. I don't see that a ton. But you're going to see, obviously, your total rents on an income on line 3. I'm going to just point out some expenses and some things to think about that I see. So advertising, if you're using any type of ads or paying for any type of advertising as you try and get tenants, you're going to put that there. Auto and travel, I see a lot of people that don't even put anything there. And you think about every time you're driving to your properties, especially if you're self-managing or even if you're just checking out your property, if you have a property manager, the miles should be written off on here. A couple other, cleaning and maintenance sometimes is applicable. Insurance, this is a really big one. I've seen it a lot of times where people, they're trying again to qualify for a lot of properties and they are not going to take all their deductions. So maybe they had a ton of repairs, but they're not going to take those repairs and other expenses, but they're not going to take those repairs and other expenses because they want to show high income and not big expenses so they can qualify for higher income on their debt to income ratio. So sometimes I'll see that where people don't take all their expenses, but a couple ones that you do want to take always, no matter what, because the lender knows that you're going to have these are insurance, mortgage interest, taxes, and depreciation. Those you always want to take. Now, something you can do, well, I'll get into that in a sec, but insurance, you want to make sure your insurance is on here. I see people miss insurance all the time just because typically you don't get a form. Sometimes it's on your 1098, sometimes it's not. So I see that missed all the time. Legal and professional fees. Okay, this is going to be any accounting, any tax prep fees, a lot of my clients put their financial planning fees on this line or a portion of their financial planning fees that we use to, help them with their real estate planning. Any attorney's fees, any type of fees like that should go on the legal and professional line. Mortgage interest, obviously this isn't your entire mortgage that you paid, but just the interest portion of it. You're going to get a 1098. It's going to show you that. Sometimes when you have a lender, sometimes your loan will get sold in the middle of the year from the current lender to another lender. So sometimes you'll get or you'll get a different servicer partway through the year. So sometimes you'll get 2 different 1098s. So that's something to be aware of. Something with repairs and supplies that you can be aware of is sometimes it makes sense to capitalize repairs if you're trying to, like I said, show more income for a qualification standpoint. But just know that when you sell the property, so basically what happens is you take those repairs and you capitalize them and you depreciate them over several years. And you get those repairs, instead of taking them, sometimes you take it all in what's called bonus depreciation, but you take those repairs over several years. Most of the time, it's going to make sense to take them and put them on the repairs and supplies line because that's an actual expense and it doesn't get recaptured when you go to sell the property. That depreciation doesn't get recaptured. So that's just something to know and to understand. But typically, you're going to have some repairs and some supplies. I didn't throw some repairs. I threw some supplies, but not repairs. Taxes, obviously, you're going to always have property taxes. Utilities, are you paying for that or is your tenant? If you're paying for it, obviously. Depreciation, we're going to get more into depreciation here in a second, talk about that. Okay, so a couple other things that on this other item that you might want to consider writing off is any like real estate classes or seminars or groups or clubs that you're part of. Like in Utah, I'm a part of the Salt Lake Real Estate Investors Association. I'm also part of the Utah Rental Housing Association. These are different rental associations that I'm a part of that have a direct impact and education piece to my real estate. So I would put those as education expenses on this other line. And sometimes it'll just say statement and there'll be several. Think of like another one that I often see people miss is an HOA fee, just because it's not listed out here. So make sure you get your HOA fees. Sometimes on occasion, I'll see people put like a home office on there. And that's something you might want to consider and think about. You could talk to your accountant about that. As well as you could also put phone and internet or a portion of your phone and internet on this line, just because, especially if you don't have a business that you're already writing that off on or a portion of that off on, then it could make a lot of sense because you can now write off part of your phone bill and you need your phone bill to run your business. But ultimately, you're going to see your total expenses here, and then you're going to see them net down here and net together. And ultimately, you're going to be able to see your total either income or loss. And this is the beautiful thing about real estate is with all your depreciation, line 18, total of $30,000 worth of depreciation between all three properties, you now have a $7,000 loss instead of a $20,000 gain, right? And again, that's the power of owning real estate is you now are able to offset that income. Instead of having to pay ordinary income tax on it, you're deferring that through depreciation and not having to pay that, and you actually get a loss. And that'll flow through to the Form 8606, right? Again, none of these numbers are matching up, and that's okay. I'm kind of just making it up as we go just to explain these concepts. So that's high level Schedule E, not too much. Just make sure you got everything. Decide whether it makes sense to capitalize your expenses versus taking them as repairs. Typically, most of the time, it makes more sense to take them as repair if you can. And I know there's like a safe harbor of like $2,500. So anything under $2,500, you can always just expense. But a lot of times if it's like a new roof or really something really expensive, you'll have to capitalize it and depreciate it. And again, that can be a good or bad thing depending on if you're trying to show more income or not. But typically if you want the best tax savings and not have to recapture that in the future, it makes more sense to try and take it as a repair this year. So that's your Schedule E. The last thing I'm going to talk to you about is your depreciation schedule. There's also a Form 4562. I'm not going to get too much into that form right now. That's typically where you'll see your depreciation. But then what I like to see is your depreciation schedule detailed list or broken out. Again, these are just things that I kind of threw in, but you're going to see a couple different things on here. So you're going to see the building, you're going to see the land. The building can be depreciated, the land cannot, okay? So in this scenario, there's a big chunk of the building or a big chunk of the property that's the building, and then a smaller chunk that's the land that cannot be depreciated. Refinance costs oftentimes get amortized and taken over the course of the loan. Okay, so that's something else on this Schedule E that you'll sometimes see as an amortization, or on that statement, you're going to see amortization on there. If you had any closing costs, typically you're going to have amortization. And then sometimes if you have a big renovation and instead of taking the expenses on your Schedule E, like I mentioned, you're going to capitalize those and take them and depreciate them, then it will be listed here. So renovations on 123 Main. So you can see all of that. Here's something else to pay attention to. The business percentage, typically this should show 100% because 100% of the building is for the business. But sometimes what I'll see is where someone is house hacking and they're living in the home or part of the home, a percentage of the home, it will be taken as business and then the other percent is personal. And that's fine. But when they move out, and I actually caught this on one of my clients' tax returns the other day, one of my newer clients, when they moved out, their accountant didn't change it and it had been actually a few years that they had just been taking 50% when they should have been taking 100%. And moving back on their situation, that cost them thousands of dollars in tax savings, literally thousands of dollars. I think I did the math. If they didn't catch that at some point over the next 27 and a half years is how long their building was being depreciated for, which is pretty typical. It would have cost them like close to $45,000 in bottom line tax savings. Again, this is super, super important that you just pay attention to it and make sure it's done right, because I see these mistakes all the time. So yeah, if you're house hacking, or even if you're not, just make sure that percentage is correct. You're going to see the basis of the property here, the life, you can see 27 and a half. They did the loan over 30, which makes sense. It's a 30-year loan. And then the renovations, they're doing it over 10 years. There's a couple different ways of calculating depreciation for renovations and how long that should be depreciated over. It could be anywhere from 5 to the whole life of the property, which would be 27 and a half, or 39 and a half, or 39 if it's like commercial real estate or short-term rental. But that is the life of how long they're depreciating it over. You're going to see right here the current year depreciation and the prior year depreciation, and then the accumulated depreciation. So this is the total amount of depreciation you've accumulated. And again, this is kind of getting off into the weeds, but that total accumulated depreciation, when you go to sell the house, that depreciation will get recaptured, which means you'll pay taxes typically at 25%. There's some different nuances to that, but that's the max that you'll pay. unless you did what's called bonus depreciation. And that, again, when you do a cost segregation and do bonus depreciation, I'll get into what that means if you don't know what that means in another video. But, if you're able to accelerate a bunch of that depreciation and take it in the first year or the first couple of years, then all of that, number one, it gets recaptured at a higher tax rate. But number two, you're going to be able to see on here how much bonus depreciation you got and how much you're able to take. And again, this can be a really good strategy if you're a real estate investor or a real estate professional to offset your business income and other things like that. But long story short is you're going to be able to see that on this form. But this is probably the final form to pay attention to. Yeah, sometimes it's good to see like the different land versus building. You want to make sure that they're fairly accurate amounts. Typically, as a rule of thumb, I see every property should be different, but as a kind of a rule of thumb, I see 20% land of the purchase price and then 80% building. Again, that's just a rule of thumb. But anyway, this is important to review. All these forms are important to review, especially with it being tax season recently. I would just invite you to review these forms, make sure you know what's going on in your situation. If you want help, feel free to reach out to me. I will share a scheduling link below in the comments where you can schedule with me. I would love to help you review your tax return. There's a lot more out there that you should be reviewing, but this is a really good starting place for most real estate professionals or real estate investors, to just know where they stand and to, make sure that things are looking accurate and that mistakes are not being made. Because trust me, mistakes are made all the time. I hope this helps, and feel free to reach out if you have any questions.